What's up, guys? It's your boy Bounce Back Bailey with Option Snipers, and today we're going to take some time and go into the options chains. So, of course, it's really important to understand your fundamentals and your technical analysis to be able to decide when to get in and out of a play. But I think one of the biggest things that goes overlooked is making sure that you're in the right contracts. So stay tuned. We're going to go into it now. Before we go, though, please make sure to visit optionsnipers.com and subscribe to our Discord or book a one-on-one session if you want to go into this a little bit more detail. Also, feel free to join us on social media. So you'll see us on Instagram, Option Snipers, Twitter, Option Snipers. We love you guys' support. We love to keep giving you guys information that helps you become the sniper that you want to be in the markets. All right, guys. So first things we're going to do is we're going to get into our options chain. So if you're in Thinkorswim, you'd simply just click trade right here. And your options chain will usually show up. Now, we want to do a couple things first. You want your option chain to have a couple key things that we're going to be talking about in today's video. The volume, open interest, percent change, theta, delta, and the bid and ask. So if you don't know how to put these on, we're going to walk through that real quick. So in your options chain, you can click layout right here. Okay. And from layout, you click customize. Now what this is going to do is allow you to import any column that you'd want to see on your options chain. You'll see on mine, volume, open interest, percent change, theta, delta. Also, two that I like to have is the high of that contract as well, and the low of that contract. So if you just search for any of these, you'll be able to get them in. Make sure you click add items or double click, and you'll see them come up in your current set. Push OK. All right, and then from there, you're going to go to save as, and you're going to save this set. So you go to save as, and then click save. Okay, now you'll see here, volume, open interest, percent change, theta, delta, high, low, and then the bid and ask. All right, so let's go into the options chain, because once again, the real key here is being able to determine what a healthy contract is and how to find those as quickly as possible. All right, so the reason why I start with the volume and open interest is because to me, those are the most important pieces of an options contract to know if it's worthwhile. If you want to envision it, think of it like this. The volume is going to be the amount of times that that contract has been traded throughout that day. So you're always looking for volumes that are frequently traded, right? Contracts that are frequently traded, I'm sorry. And you want those exchanging hands very quickly and very fluidly, because that's what you want to happen with your contract. When you want to sell it, you want it to go fluid. Okay, so you'll see here in Netflix chain, you have an 11K volume, right? A 12K volume, which means in the day that just passed, the 11 and 12,000 times these two contracts got traded. This is the 560 strike and the 600 strike. Okay. Now, the next most important and almost equally important, I guess we'll say, is the open interest. Okay. So the open interest is telling you how many of these contracts are actually being held currently. Okay. So what you want to look for is always have high open interest and high volume. And usually you want to play the strikes that have the highest open interest and volume, right? So if I was looking at this chain right here, I'd see that, okay, we got a 5,000 open interest with 11K, 12,000 with 7K. And then over here, we have a 300 volume with 13K. So, I mean, if I'm looking at this chain, I mean, you guys could tell me, but I'm sure you know, this one right here, our 600 strike price is going to be the healthiest contract on this weekly chain. The reason why? High open interest and high volume. Okay. Next up, because open interest and volume are two very important things, but the next thing you're going to want to make sure is that your bid and ask spread is very tight. So you'll see here from 95 to 104, that's about $9, right? So that's a very tight spread. You want your spreads to be really, really close together. 9, 10, maybe $15, but usually no more than 20. Like you start to see sometimes, and actually let's see them. So let's see if there's any in here that are just horrible spreads. So you'll see, I mean, this one right here is almost 30 points. Yeah, but as you'll notice, Netflix has pretty healthy spreads, honestly, which of course, oh, there we go. 29 to 70, right? Huge spread. It's a 40-point spread right there. So the reason why that's important is because if I get into a contract that has a wide spread between the bid and the ask, well, then when it comes to selling that contract, it's going to be very hard to get out of, and I'm going to have to sell it for market value or maybe even less than market value. Remember, the market value is between the median between the bid and the ask, right? So you want your market value to be really, really close to the ask. But your own market value can only be close to the ask if you have a tight spread. If you're in a wide spread contract, there's going to be too much volatility. It's going to be very hard to get out. So I really wanted to go over this and make sure that you guys understand it. I want to give us a couple more examples. So let's look at CRM. Okay. So let's look at this options chain. And once again, I want you guys to study it for yourself. Hey, if I was looking to make a move on a weekly contract, which one would I probably choose and why? All right, so you'll notice high open interest, high volume. We got a couple. And then we want to look at those spreads, right? 180, 194, 14 points. Brilliant. 1 point. We don't mind that, I guess. It's probably out the money. Yep, it's kind of out the money. So that's why. But specifically high volume and high open interest to be so far out the money. That's actually pretty interesting right there. And ooh, look at this spread. See, this is a contract you wouldn't want. You know, open interest, not very high. Volume, you know, it's higher volume. But then look at this right here. I mean, this is almost a 60-point spread. So when somebody, like, think of it like this, like you ask somebody how much something costs, and they're like, oh, it costs between $80 and $139. That's a wide spread. Like, well, can you get me a little closer to like how much it would actually cost, right? Versus if you ask how much does it cost, and somebody's like, oh, it'll cost you between 180 and 194 bucks. Okay, I can manage a 10 to 15 point differential, but I mean 40 points. That's, what is that? Almost a third of the total contract is pretty much in limbo, and you don't know what, the market doesn't know what price it would give you for it. That's a very scary contract to be in, guys. So once again, I want you guys to make sure you're always paying attention to your volume, high volume contracts, open interest, high open interest contracts. Specifically, you want try and get the highest ones you can. And then making sure that the ask and the bid are close together. No more than 10, maybe 15 points. If you're playing on a big stock, one of those like couple $1,000 a share stocks, you might want to move that to maybe 20, 25, but no, never go any more than a $25 spread. That is just my opinion. But once again, we just wanted to give you guys a little bit of knowledge here, a little bit of understanding on how to break these contracts down and really be able to pick the ones that will be the most fruitful for your investment. So this is Bailey signing out with Option Snipers. Make sure to join us on the Discord. Every day we are in the markets on Zoom trading with you. I mean, it doesn't get any better than the Option Snipers. So make sure you join us if you haven't by now. You can find out everything on www.optionsnipers.com.